Good afternoon, everybody. Welcome to our Selecting an Option Strategy webcast. I'm Connie Hill. Happy to be with you here today. And we meet every Tuesday at this time, right at the closing bell. Now, last week we had a survey, and one of the comments one of you left, actually a couple left, said, would you continue to show us tools on Thinkorswim? So my question for you today is, are you familiar with the risk profile? Now, sometimes the risk profile adds value, and sometimes you're like, it doesn't help me that much. Today, one of the strategies that we're going to focus on, it's a really useful tool for that strategy. Okay, so hang on, we will get to that. Now, I am joined in the chat by Cameron May. I'm happy Cameron's here. He will help me maybe fill some questions that I can't quite get to. And I hope you're following both of us on X. He's Cameron May CS. I'm Connie Hill CS. We'll post educational content out so you can view it. Now, one thing in our X profiles, one thing you're going to notice is we're starting to post some short videos, okay? When you see those short videos, they're really probably not going to take more than a couple of minutes. That's how short they are, but just a little burst of information. So I want you to be aware and looking for those videos. Now, let's go through our disclosures. I'll lay out our agenda here for today. Options carry a high level of risk and are not suitable for all investors. What we're talking about today is general information and education. Don't consider it a recommendation. We will be using the Paper Money software application. This is what you download to your computer. It's the most robust version of Thinkorswim and has these tools available for us. Past performance of any security or strategy does not guarantee future results or success. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. This is something we like to stress on your Paper Money account, that it does not mimic the market in that regard. It typically is not going to assign you early, but the real market absolutely can and will. All right. Our agenda, we typically like to take a look at what's been going on in the market, because as we have a feel for that, that is going to guide us to maybe what some strategies are that might be useful for us. Okay, so we are going to look at some strategies. We are going to look at that risk profile tool as we look at some new setups. And then I have a couple of follow-ups to do on some trades that we have going on right now. Now, let's take a quick look at what the strategies might be. If we're more bullish, maybe concentrate over here. If we're more bearish, maybe concentrate over here. We really have been out in the bearish strategies quite a bit, though, in the last few weeks. And then more neutral strategies could be an iron condor straddle, calendar, butterfly, double diagonal. Those would be examples of neutral strategies. Okay, let's go see what we're seeing in the marketplace, because we always want to trade what we see, not what we think, right? And we'll start out here with the SPX. It looks like, and I was going to look at all the markets, looks like maybe all of them ended up a little bit down today, even though initially they started up. I know this chart is quite busy. I'm going to maybe back out here just a little bit, maybe go back out to 6 months, because you can see we were up here at 61.47 on the SPX. The low got down here to this 4,900 area. That's a pretty decent pullback. We are currently about, this is where our 200-day moving averages is the green line. So prices haven't quite got above the that 200-day moving average. When and if they do, that would be a good signal that some people might wait for. Some people might be a little bit more aggressive and say, well, I'm going to look for movements above shorter term moving averages. Okay, so this blue line is our 10-day, and as of yesterday, it closed above our 10-day. The 30-day is right here in red, so it's not quite up to that area yet. And this 55.11 area should be an area of resistance. We'll see if it acts that way or not, but we had a bounce there, another bounce there, and then a breakdown below it when it started forming that flagpole. All right, so kind of think to yourself, what are you thinking more so, bullish, bearish, or neutral? Let's look at the NDX as well. And it's a very similar looking chart in that it's well below the 200-day moving average. It's well below the 30, but that's actually a little bit more in reach. And it has a day sooner of being closed above the 10-day moving average. So maybe a little bit ahead of the SPX in that regard. However, we've got this long diagonal, what had been resistance, and we're going to see, is it bouncing its head on that resistance here again today? We'll see when we get some follow through tomorrow in tomorrow's market. Okay, so are you feeling more bullish, bearish, or neutral? Go ahead, chat into me while we take a quick look at the VIX. The VIX has been dropping. You probably know that. This peak point was up here at 60, which is really high volatility. And just in the last couple days, it's kind of stretched down into this 30 area. So maybe volatility in terms of numbers going from 60 to 30 was obviously bullish for the market. Today, not a lot of movement on that VIX. Looks like maybe it was down, 2%, which is not a whole lot on the volatility index. I would say because it's above, say, 26, 27, that it's still in a higher volatility range. Certainly not as extreme as what we experienced. You might not feel your stomach riding the waves of the roller coaster quite so much, right? But still a little bit higher. So our expectation is that options are going to be a little bit more pricey. That could be advantageous if we are a seller of options. And if we want to be a buyer of options, it means maybe we should consider doing something like a spread. So we're just not paying a super expensive price for that one option, but maybe doing something a little bit more risk defined, even max profit defined, in order to help ourselves with that increased volatility. All right, I'm going to look out. I'm going to see what your question or what your comments are, where you were thinking a little bit more. Kurt's more bullish, Steve's more neutral. David's neutral to bullish. Scott's neutral. Greg's neutral. All right, Ricebird's on the fence. Not really quite ready to commit yet. That's all right. Yeah, Steve said, it's, a wise man told me cash is a position too. And you're absolutely right. If you're not comfortable moving ahead in any market direction, there's nothing wrong with waiting till you start to see signals on the chart that you like to see and seeing the confirmation that you want to see. Okay, so nothing wrong with that at all. As we head back here then to maybe some of our possibilities here, what we might consider. Many of you were in the neutral strategies area, right? That's kind of where you were feeling about things. And so that would be maybe an iron condor. A straddle, although a straddle, you typically need either a big move down or a big move up on it, versus some of the connotation here maybe for neutral is that it stays range bound. Calendars typically are not looking for real giant moves. We're looking for more contained moves. Butterfly spread is quite a low probability trade, and you kind of have to nail where those strikes are that you sold in the middle of the butterfly in order to, start seeing some profitability there. Double diagonal could be a possibility, and as we start getting into earnings season, we may look at this a little bit more. Okay, today we're going to look at a lot of calendar spreads, particularly put calendars. Okay. Let's go ahead. Let's take a look at our first stock that we're going to examine here. So we'll go back to our Thinkorswim. Yeah, Steve says, or maybe a strangle. A strangle would require a big move as well, wouldn't it? We're expecting it's got to move fairly big on a strangle because you're buying the call, you're buying the put, and you have to have enough movement to cover that premium of either side, and plus have it go a little bit more to gain some intrinsic value in the option so that you can be profitable in it. So there are obviously different ways you can approach things. I'm not saying that absolutely this is the only way to approach a neutral strategy in the market, but I think it might be appropriate for what we're seeing out there right now. So first one we're going to take a look at is Reddit. Now Reddit's been fairly downward trending since it peaked here in February, making lower lows, lower highs. Look at that, going down below the 200-day moving average recently. So it took a while to get there. And right now, as we maybe kind of dial in on this a little bit, it looks like maybe it was trying to get some inertia going here. But ultimately, it formed a lower low, right? This low is lower than that previous low. And say the previous high was, say, right up here near that kind of that crossover of the 200 and the 10. That looked like, okay, that's a kind of a more recent high, and it didn't get above it, even though it had a giant rally day. Just not, I mean, it was a big move all across the board, including Reddit, but not enough to really get it above that resistance. So we see it pull back again. And, you know, yesterday's rally wasn't much, but we're just seeing this pattern, lower lows and lower highs. Now, on a calendar spread, what we're going to do is we're going to sell a contract. In this case, we're going to do a put contract because we're more bearish, and we are going to buy a put contract. Typically, when you're selling, you're going to sell a sooner time frame, and the leg you're buying is going to be a little bit further out. Now, if the stock continues to drop, what is likely to happen with implied volatility? Is it likely to go up or go down? Okay, in terms of implied volatility when the price of the stock is dropping. Now, I hope your answer to yourself or to your dog was that it goes up. Well, that would be beneficial if we had a longer put, wouldn't it? Now, on this, I'm going to kind of come over here. I want to keep in mind that it has earnings on May 1st. And so many people might want to be out of a trade by May 1st if they absolutely don't want to hold over earnings. Okay, so we're just going to kind of keep that on our radar. But it's far enough away that it, you know, we possibly could be out of the trade before then. Okay, let's go put a trade together, and then we're going to look at it in the risk profile. Kind of honoring the request, it keeps showing us how to use some of these tools. And the risk profile for a calendar, I think, really makes sense and adds a lot of value to your analysis of the trade. All right. I'm going to show you what we're looking at here. We're going to be looking at the May 2s, 17 days, May 16s. That's going to be our long leg. On the monthly expiration here in the May 16s, we only have $5 increments. That's going to be a factor because of, as we're up here in the May 2s, we've got single dollar increments. And so even though maybe you might want to do a particular strike price, you know, say maybe you're interested in doing 93 or 92, if we're doing a calendar, we've got to do the exact same strike price. Otherwise, it's going to be a diagonal. Okay, but today we're focusing on calendars. And so that's going to play a role in what strike prices we're going to use. Now, many times, if we're looking to bias ourselves a little bit, we've either got to be bullish with calls or bearish with puts. So we're going to be bearish with puts. Current price of the stock looks like it closed at about 96. And many times traders will want to sell a little bit out of the money. That means we could sell a 95. That's a little bit out of the money. We could come out here to the 90, which is a little bit more out of the money. Okay. The one we're going to choose is the 90. Okay. 95. I mean, it's okay, but it's only $1.46 away. So there's not a lot that we need the stock to do. And I'm concerned it may pass it pretty quickly. If we come back over here to the chart and we see, well, where would be 95? Well, 95 would be in today's shadow of that candle. Okay. Its low went a little bit lower than that. And where would 90 be? 90 would be about here. Okay. So that does give us about $5 of leeway that we're looking for it to drop. And I'll show you on the risk profile, that is our ideal place that would love to see the stock land. Okay. So let's go put this together. We're going to start with our short leg. We're going to come out here to the 90s. And the reason I'm really going to focus on the 90s is because of those $5 increments and needing to see some decent open interest if we're going to do some contracts. You know, 4 and 2 contracts, only 6 there, only 11 there. These are just really too skimpy. Okay. If we did not have a little bit more out here in the 90s, would probably skip on the trade. Would go, never mind, or put something else together that looked a little bit better. But what we're going to do here, we're going to do a right mouse click. We're going to say buy, because it will be a net debit, and we're going to choose a calendar. All right. Now, it by default goes and grabs the next month, which is the May 9s, but we're going to use the 16th. So we're just going to trade it, change it up here. And we'll put that May 9 down at May 16. So we've got two weeks between those strike prices. Now, it brings our net debit down quite a bit to $1.40. The other thing it does when you do a calendar is that the deltas aren't really far apart, okay, because we're using the same strike prices. We're just widening out the time frame. So, and I want to show you that because that's kind of a consideration when you're thinking about these calendars. So if we look at, say, the May 2nd's 90, we've got a 34 delta. And if we go down here to the May 16's 90 strike price, we've got a 35 delta. Okay, so we've got a 35 and a 34. See how close those are to each other? That means that the trade can be a little bit forgiving if it goes the wrong direction on us immediately, right? Because those deltas are pretty close to offsetting each other. Now, if the stock does drop, we're expecting our implied volatility to rise, which is going to be good for our long leg, the May 16 here, okay? I want to show you this on the risk profile. We'll do a right mouse click, analyze trade. And some of you may be familiar with the risk profile. I'm hoping some of you you've seen it, you know, in my class or somebody else's class, that you're getting familiar with it. It's not something that you see once and you're like, oh, good, right? It's something you typically need to see several times, okay? In fact, I would be willing to bet, and I could be wrong here, Cameron, but I'm willing to bet that you have taught in your Thinkorswim class about the risk profile. And if there's one that is easy to access, that might be helpful to post here in the chat for those that you want to do a real deep dive on it. But let's kind of lay it out here. Here is the money, okay? This is our profit and loss. You can see it goes up to plus 600. And right here, oops, I did that a little wrong, is 0, which is basically our break-even area, okay? So we're liking to be up here above that 0 line. And then down here at the bottom is the price of the stock, okay? So it's going quite a ways here. You know, 55 over to, I'm going to say 117 or so. These can get a little scrunched together, so we might just kind of, move that over a little bit so we can see a better definition. Now, up here in the upper right-hand column, actually, it's not the column. I'm going to maybe say the corner. We're going to have a date right there. This you want to be the expiration date of the option that's the furthest out. So in our case, we need to set that to May 16th. And then this date down here, we'll adjust that. Many times it'll come in as today's date or the last date that was put in there, so you can do some what ifs. Last week we spent some time on the theoretical price calculator, and we were able to play what if, right? What if the option does this? What would we expect? What would the price, you know, ballpark move to based on our move and our time decay and so forth? We can do a similar type thing here on the risk profile. All right, for price slices. Price slices are essentially this dotted vertical line. And you can see on this one, we've got a couple of dotted vertical lines. We even have this one out here as well. And what we're going to do, we're going to set these price slices to the break even. Okay, break even of the trade. So we're going to come down to right here where it says Theo price, that line right there. We're going to click on this icon. We're going to say set slices, those vertical bars, to the break even price. And then it's going to pick here, it's going to pick the May 3rd contract. Well, the May 2nd contract that technically expires on Saturday the 3rd. That's the one that it will only give you a choice to. It'll give you the earlier or just, well, it gives you the earlier basically, okay? So 5-3. Now I'm going to come down here and we're going to reset our date to today, tax day, right? April 15th. Hopefully you've got your taxes in and hopefully you didn't have to pay a whole lot on them. That's what I always hope for. And when we set reset this and said, set the slices to the break even, look what it did. It moved these lines. So we've got a line here. It's mostly correct, 74.20. And I shouldn't say mostly correct. This is where it's calculating it out to. And this one says 112.46. So that is a pretty wide range where we would want the stock to go, right? Our peak profitability is right here at our strike price at 90, okay? Now remember, this kind of teal colored line is our profit and loss at options expiration. This purplish line is our profit and loss as of this date. So we've just got here on today. Looks like Cameron has posted out a nice video. So those of you who want to take a deep dive in it, Cameron does a really great job with the Thinkorswim class and showing you how to use those tools. Okay, I'm not going to go so deep into it, but there may be some of you interested in it. So we've got a pretty wide berth, which is why this falls into the kind of the neutral category of strategies, because it's got a big range. Now, in an ideal world, which doesn't happen very often, in an ideal world, the stock would expire right here at $90 on options expiration day. How likely is that to happen? Probably not a lot, but if it were to, it's saying our peak profitability there is $579. So we would be risking $1.40 to make $579. It's like, wow, that's a great risk reward ratio, right? But we don't want to count on it. It's probably a little bit more realistic to say, okay, it's not going to end right at 90 where we'd love it to, but maybe in a range. And so something you can do as you're getting into the trade is decide what range you want to target for, okay? And it might be just barely above break even, or maybe you say, if I risk 140 to make 200, maybe you'd be comfortable there. And so you bring your mouse up here to this line to see, okay, what would the price of the stock need to be? So roughly in that range, it needs to be in the neighborhood of 81.39, which is not that far away. Or where's our $200 along here? Maybe something in the range of 101-ish. Okay. Now, as we change the date here, and if we change volatility, then it's going to adjust what we're seeing here, just like the what if. Okay. So I'm down here, and I'm going to kind of draw this for you because I want to make sure everybody is down in the right area for this one. Okay. That's where we're going, is another little mini calculator. And we're going to click on that gear. When we click on that gear, this new row appeared for us. It wasn't there before. And so we can come in here, we could say, okay, what if, instead of having today be today, what if in 2 weeks? Okay, that would certainly, before they announce, be a day or two before they announce their earnings. Okay, so let's maybe on our calendar, let's go ahead to the 29th of April. And let's suppose that maybe the implied volatility, let's suppose the stock has dropped because it is looking bearish. It is looking like we want it to go down. And so you can put in a stock price here. And as you go in, put in different stock prices, you'll see more value. So what if the price of the stock goes to 90, right where we want it to go in 2 weeks? Our graph changed here a little bit, and we see our profit and loss line at the current date, which we just moved it ahead to the 29th of April. So now this purple line is graphing these prices. If the price of the stock were to go to $90, close to or around this April 29th date. And then you could see, actually, that puts us pretty close to that $200 range. And you could say, if it doesn't, maybe you're content there. You're like, sweet, I risked 140 to make 200, happy camper. Okay. Now I have to tell you, many times we're waiting for that time to decay. And so at the beginning part of a trade, that short leg is not decaying. I mean, it's in a fast decaying area, right? Because it only has 2 weeks before it expires. But, the first couple of days don't decay as much as when it's getting closer and closer to that option's expiration date. Now, I am curious, how many of you have traded any calendars before? How many of you out in our class have traded any calendars? I'm going to kind of take a look here and see how many of you have. I'm curious to know that. All right. When we changed our parameters down here, something else I want to point out to you is that our probability range kind of adjusted. Okay, our probability range is basically where our break even is here, right? Our 74, 23, and 112 and 40 something. And this number up here that basically says, okay, remember last week we talked about the bell-shaped curve? The bell-shaped curve is this gray area. Now that was not a perfect bell-shaped curve, okay, but just the general idea. So in 2 weeks, if it's about 90, yeah, it has a 92% probability of expiring in now this range, right, where that light shaded gray area is. Now, I do think using the risk profile on calendars is very helpful, okay? Do we have to wait for a certain type of entry? Not necessarily, okay? We don't need to. But we do want to be thoughtful about, how much time do we want to sell? How much time do we want to buy? Okay, so we're going to go ahead. We're going to put in this trade. And next week, what we'll likely do is change our date down here to be next week, which would be the 22nd. Just kind of take a look at it, see what it's looking like. And then after that, on the 29th, before we get to their earnings announcement on May 1st. Okay, so several of you haven't had a chance to explore this strategy yet. Not a problem. I'm glad you're here for that. David says yes, but not many. Okay. Vic says traded calendar, but not as a starting point, but build it over time. Okay, so you kind of legged into it, is what that sounds like to me. All right. Every example we're going to do today is going to be a put diagonal. I mean, a put calendar, just like what we've got set up here on Reddit, so that we get this repetition. Okay, so let's go ahead. If we are risking 140 per trade, and quite honestly, you do not see, we have to like really squish in our time frame here so we can see how long it takes it to hit its max loss range. Okay, we have to go clear out here and they're even still just really, really close to each other through here. But basically after about 140, we start getting close to that max range. And if we do just the opposite, then we can see, okay, our max loss right there is at 140. On this side, it takes it kind of a little bit more time to actually get there. But on this trade, if we just pulled it up and said, what's our risk reward ratio? We'd kind of be like, I don't know, what is our risk reward ratio? Because it's completely dependent on where the stock goes from here. Okay, that's why the risk profile, I think, is so helpful for us on this trade. Now, if we're going to risk 140 in our class, we're willing to risk $1,500 a trade, but there's not oodles of open interest here, so we're going to scale back. On here, we'll do 10 contracts, okay? But if you weren't even comfortable at 10 contracts, you could go lower than that. Actually, do you know what? If we have 10, if we had our max loss on this at 140, that actually puts it at 1,400. So let's even scale off there a little bit more. Let's go down here to about 7. We'll go 7 contracts on this one. All right. What about getting out? Many people don't like to actually put in an exit order yet. But what they might consider doing is putting in alerts at a range they've decided, hey, if it gets in this price range and it's a decent profit, I might consider getting out. Okay. So for right now, we're not going to put in an order, but we will want to be watching it, right, on that risk profile. Hey, where are we in a range where we would be content with that profit? Knowing that it can always change, right? Meaning the profit and loss throughout the day could always change. So we're going to hit confirm and send here, and we are going to drop this in our option strategies bucket. Now, as we went through that first example, do we have any questions? Market's closed right now, so we're not going to get filled on that. So I'll make sure we get filled on it in the morning. John says, how can one have a calendar in the market like we're having today? How can we even predict what trading will bring? Very good point, John. Yeah. And that's why possibly a neutral strategy might be appealing to some people, right? Because, yeah, we don't really know. And it gave us that when we were on that risk profile. And we'll go back there again. And I'll put it back to today's date. That's why we're like, yes, a long range. If we can have the price of the stock stay in this long range, because we don't know where exactly it's going to go. You know, maybe it stays put where it is. We don't really know. And so that's why it's nice to have this big, wide range of where we want the stock to go. It can go up a little bit. It can go down a little bit, right? Just depending. Okay, so good question. Let's look at another example here. We're going to go back to our charts. And our next one that we're going to look at is Target, TGT. Now, Target, bless its heart, just has been struggling. You know, Walmart's been creeping up, right? Target just down, really struggling. So same thing. We're looking, you know, it's kind of been going a little bit sideways here. It's not like it's taking really big drops right now. It is at a support level here. In fact, in another class, we're doing another trade where we're saying, hey, you've got to get below 90 in order to get into the trade. But here, again, it doesn't matter so much as far as, hey, just my entry. Is it the bounce off resistance? Is it the bounce off the moving average? Those kind of things can be useful and helpful, but they're not quite as required and don't need to be quite as specific when we're trading neutral strategies. We get a little bit of leeway on it. Okay, so current price of the stock is at 92. 90 is about where that white line is. And really, the next strike down that we would consider is 85, but it's quite a ways down there. Okay, that would require a pretty big move. And so if we were trying to stick with maybe those $5 increments, we're going to find the same thing with Target that we found on Reddit. Okay, so we're going to come over here to Target. And we're going to see, yeah, the weeklies do have these single dollar increments, but the monthly is not going to. Okay, the monthly is going to be in these $5 increments. So that's why it's a consideration. Now, looking at this, we're going to use the 90 strike price, and I failed to acknowledge that trade. So I am going to, we're just going to actually knock it out because I don't want it to embed the strike prices. And I can do something different with that. So I'm going to go ahead and cancel that. Because otherwise it would put us kind of in a ratio spread because we already have some strike prices at that 90 strike price. Okay, can I come up to the month we're going to sell? We're going to choose 90. Currently that's at about a 39 delta. And we have a few contracts out here, but a little bit more in those $5 increments than in the single digits. So we're just going to right mouse click. We're going to buy our calendar. All right. And again, it just picks up the next month. So we're going to go change it. We're going to put this out to May 16th, where those monthlies are. And again, you could compare the deltas if you wanted. There's 35 delta there. And on the 16th, 41 delta. So a little bit more separation, but they're still pretty close to each other so that we have a little bit of buffer if the stock doesn't go the way we expect it to as quickly as we might want it to. So I picked 89 there, and I meant to pick 90. So let's just fix that. There we go. Okay, so 143 net debit. Okay, same thing. We're going to look at the Analyze tab. Right mouse click to bring that up. And I'm going to get rid of what was there previously. We really only want it, we don't want it to show us any positions. That's one other field I should point out to you here on the risk profile. If you do have a position in it and you're looking to see your overall with the simulated trade in there, then you would say, yeah, show it. In our case, if we have any positions, we don't want it to take that into consideration. Okay, we just want to look at this trade only. Interestingly enough, 90 is the strike price here that's in the middle, right? That's the one we're selling. That's where our peak profitability is. So in this case, and we've got our date back down there, I'm going to just see if this makes any difference. Set our slices to the break even. So it's set at our break even points right here. What's the range? 85 and some change and 95 and change. Okay, that's a $10 range. You know, you don't get that kind of flexibility with all trades. You just don't, right? And so that's why we're saying neutral, waddle around in this range between the break evens, hopefully maybe a little bit higher into our price or profit loss line at options expiration. The higher it is on here, fabulous, okay? But nice to have a little bit of a range. One thing we're going to do here, we do have, I've kind of gone through a decent explanation on the risk profile, so I hope it's starting to make sense as we throw another trade on here, okay? Our break evens, where they are, seeing this long range, seeing where our peak is. We could come down here again and play what if. Now, earnings are not a question on target at this point, okay? Not coming up in the near future, I believe. So I've got mine set to 4 weeks out, and they just barely had their earnings. Retailers are kind of at the tail end of earnings season, so they had theirs on the 4th of March. So we're looking a couple months out before it would do that, okay? So we're going to go ahead. We're going to put this trade in. We're going to do, on this one, we have similar risk, about $1.43 on here. Let's go ahead and let's do 7 contracts here as well. We don't want to be a big bunch of the open interest, right? We want there to be a lot of contracts to trade back and forth with. We don't want ours to be like the big chunk that we're stretching to have to get in or out of the trade. So we'll do 7 contracts. We're going to hit confirm and send. Again, we're not going to put in a physical stop. We'll put this in our option strategies bucket. Now I'm going to go back here to the risk profile for a minute. And let's say 95. Let's go 95 and 85. We're going to put alerts as close as we can to, I'm going to try to get here close to 95. We want to create alert. If it goes up to there, so at or above 95.13 is fine. And then 85, that would be lower than where the price of the stock is. To see that, probably have to jump down here a little bit. And we're going to put an alert at 85-ish. Okay, it's not perfect. We're going to create an alert if it goes at or below 85.16. That is how we're going to keep track of it. Besides looking at the chart, if it kind of goes in one of those ranges, then we're going to be interested in knowing that and going out and check and saying, okay, what is our profit? Is it in a range that we think maybe it could, I'm going to use the term swim around in. That's not a technical term, but just kind of mosey around in, just kind of like it is right now. It's just kind of hanging at that area. Let's answer a couple of questions here. Ted says, so if you don't close the trade early, would the expiration or the expectation be to roll the 2 May leg or close the May 16 leg? Yeah, really good question, Ted. Ideally, it could go either way. It could be that maybe you get in a good position. You're like, I'm just going to go buy back the short leg. And maybe it's moving towards your long leg. In fact, some people might even come out here and maybe they close the May 2nd and maybe they sell a May 9th. Okay, because those are available too. And hopefully the open interest would get, oh, this one has some decent open interest here at 381 contracts. And so that's a possibility of selling something else, kind of extending the trade, kind of bringing in a little bit more money to lower the net debit on the trade. Yeah, so excellent. Now, if we were out 2 months, we would definitely be looking, or even 3 months or longer, okay, we would definitely be looking to roll, take some money off the table, roll it to the next short period, short weekly that we're interested in, and possibly do it over multiple periods of time. So this is a kind of a shorter range one. So we might roll it once, or if we're in a sweet range that we're happy with, we would want to close the trade. Okay. After our class is over, I'm just going to show you this. We don't have time to put it on right now on UPS, but we're going to do a put calendar here on UPS. Again, just kind of slump it around here. And they have earnings the 29th. And it's possible we could be taking credits or taking hopefully profit or closing up the trade before it actually gets there. We don't have time to do that right now, but the strike prices, my plan is to do 90 as well, right? That's kind of the next. We typically are going to go a little bit out of the money. 95 is really close, and so we're going to go for the 90s on this. Now, I do want to show you something with AU and a little bit of follow-up from our conversation last week on collars, right? We had looked at this as a possibility of being concerned what was going on with the stock, and so what do? We put on a collar, which means we bought a put, we sold a call. And, you know, think of it kind of like an umbrella. How long do you keep your umbrella out, right? If you no longer need your umbrella, it's nice and sunny outside, we put the umbrella away. So on our chart here, when would that day have been for you? Okay, here's the day we were looking at it. That is, well, actually, we were looking at it here. And then we had a day, dropped a little bit, and popped and popped. You know, for some people, this candle right here would have been the day to say, you know what, it's above the 10. It gapped up here. Maybe we don't need the umbrella anymore. Okay. And so some people may have on this particular candle chose to exit. Okay. And say, okay, don't need my collar anymore. It's not benefiting me. Certainly by this gap up day, I think that would be a most certainly. You definitely know you don't need the umbrella. Okay. Hopefully that makes sense to you. I don't know how many of you experimented with some collars, but hopefully it's something you have in mind as far as, you know, when that takes place. Now, if you missed that session, you can always go back to our YouTube channel and check it out. Let's see here. Let's get to the right screen. And it's going to be right here. And we're going to go to this tab here. Remember, if you've subscribed to our Trader Talks channel, you can't see that little blue YouTube icon in the bottom right corner. You can select on that to subscribe. You can also select on it to unsubscribe. All right. So only click on it once. All right. And then it makes it a lot easier to find these classes. You can come over here. You can find the playlist for our class. Go down about 7 rows. And right here is selecting an option strategy. And you can just go in there and see last week's class and play that for it. Okay. So if you wanted to go back, interested in that strategy. Okay. So make sure you're a subscriber. Just makes it easier. I'll encourage you again to follow Brent and I on our X accounts. Not Brent, Cameron. You can look at Brent too. Actually, it's Cameron that's here with us today. So yeah, we encourage you to follow us so you can get in on those little nuggets. All right, this is being a little silly. There we go. I'll click over here again. So that's pretty much what we did. Reviewed market conditions. We're sticking with the neutral strategy, neutral to bearish, right, for those short calendars. And then the other thing, we don't have a survey out here today. And so if this was helpful for you today, go ahead and hit that like button on your way out. That lets us know that you found it valuable. It also will allow it to move up in the algorithm so it can help other people find the class here as well. Well, Cameron, thank you for your assistance today. They took it pretty easy on you. All right. Yeah, just checking the chat here, seeing if I can help Bihal as well. Oh, can an earnings, you're wondering if you can get an earnings icon to show up in the option chain. And you can't on the option chain, but it does show if you've got it like some watch list of stocks, you'll see those little icons off to the ticker symbol when you're looking at it as a watch list. Okay, then you can see it there before you even get into the option chain. Okay, Very good. It's the last class of our day. We'll be back bright and early tomorrow morning with our Trading the Markets. And then I'll be back on Thursday talking about short verticals. That session is at 2 Eastern time. Love to see you there. Have a good evening, everyone. Good night.